Welcome to this week's Q&A. We've got a question this week from one of our viewers in the US, and he's asking what we should do if we get a multi-year period of high inflation and high rates. Now, it's a great question. It's very broad, and we need to think about, how high these things actually go. So in terms of inflation, what do we consider to be high inflation in this current period when we look back at, say, the last decade, where we've had very weak inflation numbers, not really going towards the RBA's target band of 2 to 3% in most instances. So we've had a very, very modest rate of inflation. However, prior to that, inflation has been far higher during the course of history. And the other really important issue is not just how high nominal interest rates or official cash rates go up, but what impact that has on real rates. So if we look at the nominal rate and take inflation away from that, what's the real rate of inflation, the real rate of interest? And in most instances, that's still going to be perhaps slightly negative or neutral at this point in time. So if we have in, say, Australia, the official cash rate does get to 3.5% and inflation is running at 3.5%, then the real interest rate is zero. And of course, the other question that really needs to be answered when we're looking at this whole concept of what's going to happen to asset prices, I suppose, in the main, to the economy, to people's purchasing power and lifestyles, is what happens to wages growth. So if you've got inflation running at, say, 3.5% and you've got wages growth at 4.5%, then the consumer is likely to feel a lot more comfortable than if that was the inverse proportion. So wages growth is going to be important. And the other thing that I look at, I guess, when we're considering what might come up in the medium term, is what are the likeliest scenarios, and clearly they can be quite broad because there are so many uncertainties in today's global economic marketplace that it's very difficult to make some of these predictions. However, if we look at the global situation as it is now and the likelihood of inflation continuing to increase for a period of time, and then potentially looking at a decline in that as some of the supply chain bottlenecks perhaps can get rectified, and as central banks raise their official cash rates, that consumer demand can be moved lower, we need to look at what's happening in, say, the US markets, where the biggest asset that individuals hold tends to be in equities, and we're seeing now a downdraft in US stock indices, especially the NASDAQ down over 25%, the S&P 500 down close to now 17-18%. So some of these things need to play through so that people actually stop spending as much as they have been, and that inflation then does tick down from that consumer demand level. So lots of things to look at, but I mean, what should we do? And it's a very broad question. We need to potentially be mindful of all these things, be more diversified in terms of asset portfolios, and look towards a more defensive positioning during this period of rising official cash rates, because that will put pressure on risk assets, so equities, property, but all mark-to-market assets seem to be getting caught up in this. And as I've said over the last couple of years, bond markets to me have been perhaps some of the most expensive assets that we see in the global sort of marketplace, and they've certainly felt the heat in the first quarter of this year on an ongoing basis, coming through April and now into May. So remaining diversified, being cognizant of what may happen, and being able to maintain one's asset positioning, I suppose, in terms of investments, is really the crucial thing, so that you can ride out these periods of volatility without having to liquidate your assets, because that would generally occur at a time when it's going to be least opportune for you to do so. So bear all that in mind. Remember to look for quality assets in whatever it is that you're purchasing or holding, and keep it tuned, because these situations move around fairly rapidly at the moment. So I think people need to continue to do their research. It's very important in all asset classes, and as we've said, certainly in the Australian property market, it's very important, because different markets are going to react quite differently as we see this play out. So everyone needs to keep an eye on these things, as we do. And if anyone needs any assistance on a personal nature, please reach out. If you like what you hear, subscribe to our YouTube channel and click like. I'm Andrew Unterweger from Wise Guru, and I'll see you next week's Q&A.